Hello and welcome to Wescott's latest market update. I'm Mark McCarron, Wescott's Chief Investment Officer. And today we want to give an update on the economy, the markets, and also the implications of the upcoming presidential election. So as usual, we want to talk a little bit about the markets today, how they're behaving, what the leadership looks like. We'll then turn our attention really to what the upcoming US election might have in store for markets going forward. And then finally, our current outlook. So we have a little bit of a new format here, a little bit of a new design. We hope you like it, but the messages hopefully remain very consistent in the sense that first and foremost, our market update does go through October 9th, which is today. And if we take a look at that, let's first start with some of the key factors that are driving the market. And all attention continues to be on the unemployment situation in the US. If you remember, way back in March, unemployment spiked to 15%, which is a shock to the system, of course. Slowly but surely, that has recovered and healed a little bit. And today, the unemployment rate remains just under 8%. So about half of the jobs that were lost during the height of the pandemic have been recovered. However, the uncertainty with respect to the course of the virus and uncertainty for business leaders as to whether temporary unemployment turns to permanent unemployment continues to keep some employees at home. And the recovery that we're seeing so far this year may be at risk of stalling if that's not resolved. One of the key components of getting some stability in the market has been support, not only from the Federal Reserve, which we talked about before by keeping interest rates low, but also by Congress and the White House. And despite some setbacks, negotiations of an additional coronavirus relief bill continue this week between the White House and Congress. And that's really important because that will tide over many businesses and households until we get back to normal. And obviously affecting almost every decision out there, whether it be investment or business, is the upcoming US presidential election. It's less than 4 weeks away. And what we're monitoring very carefully is the market behavior. And one of the things that we can look at is market volatility, which remains stable, although it remains stable at an elevated level. And we'll talk more about that. So first, let's talk about what we're seeing in the market through October 9th. So after a brief sell-off in September, where the markets did fall, stock markets have continued or resumed their move higher. So far in October, the S&P 500 index is up 2.6%. But what's pretty interesting about this period, which admittedly is a very short-term period, just the end of September, which is only a few weeks ago to today, the market is being driven higher, not by growth stocks or technology stocks, but by broad financials, industrials, energy, other areas of the market, particularly the value side of the market. And you can see that in really a reversal of what's happened the entire year, where the growth index that was driving markets higher is still up 1.8%. But small companies and value stocks, as represented by the Russell 2000 Value Index, up already 9.2% this month alone. And so what we see is a broader market. And this market leadership shift as the start of the fourth quarter is generally, and it suggests a broader market, meaning the S&P equal weighted index is up 4.8%. And that's a positive for Wescott strategies because we remain more diversified and globally diversified rather than just focused on US technology. And so one of the things we're going to talk about later is this shift potential from the pandemic trade to the recovery trade. And this is terms used by bank credit analysts and in their most recent research. And what they mean by that, and what we mean by that, is that the pandemic trade is really the driving leadership of the stocks that are doing well in this environment. And that shift maybe from what stocks might do after this current environment is over. And that's really that recovery trade. And the short answer is that growth companies that are doing very well today will continue to, participate, but we might see recovery in other parts of the market. So we talked a little bit about uncertainty. There's a index out there called the Stock Market Volatility Index, or the VIX index. It provides insight into the level of uncertainty in the stock market, and really the way to read this is that the higher the index, the more uncertainty there is in the market. And so what we're showing here on the right-hand side is a graph of the VIX, of the volatility index. And back in March 2020, that index spiked to levels last seen during the 2007 and 2008 credit crisis. And that's because the uncertainty surrounding the pandemic-induced recession that shut down the economy was so great. Clearly, we've seen a drop in that uncertainty index, in the VIX index, but what we've seen is that it hasn't fallen all the way back to where it was before, and it's remaining at an elevated level. And I think the uncertainty surrounding the virus and the rise in case counts and the implications of the upcoming U.S. election are keeping volatility at these levels. But it's important to note what's happening underneath the surface with that level of volatility in the market and the potential shift in leadership, all of which is really important to manage risk in a client portfolio. So let's talk a little bit about the implications of the upcoming U.S. election. So I think we're in the home stretch. We're about 4 weeks away, as we mentioned. National polls and betting markets, which we'll talk about in a minute, predicted is one of them, suggest that Democrats are favored in the presidential election in November. On the right-hand side, we're showing the odds of the 2020 presidential election result. The blue line indicates the odds for a Democratic win, and the red line shows the odds for a Republican win. And this is updated every day. And first, a word on Predictit. It's a New Zealand-based online prediction market that offers exchanges on political and financial events. So it's basically you can go in and bet, if you will, on what you think might happen. And putting that out there rather than particular polls is pretty interesting, because like the stock market, it's a betting market, meaning you have buyers and sellers, and at the end of the day, that will aggregate into trends. And what that's showing is that the Democratic odds have risen to about 67%, whereas the Republican odds have fallen to about 37%. First and final comment on Predictit is it's not in Las Vegas or any other gambling location. In fact, it's located in New Zealand, and it's owned and operated by Victoria University of Wellington there. So it's a pretty independent and nonprofit organization. In terms of the Electoral College, which really matters the most in terms of who ultimately wins the White House, Pennsylvania, Michigan, Wisconsin, and Florida remain the focus of both parties. So as we head through to November, we want to talk a little bit about what the implications would be of in fact, a Democratic White House if the betting markets and the polls remain accurate. So first of all, as we've always said, markets tend to focus on the economic policies such as taxes, regulation, spending, and trade of the candidates. And let's take a look real quickly at the economic policy changes to expect in the event of a Democratic White House. But if there's a mixed Congress, meaning Republican, Democrats sort of split, then all of these policy changes may not go through. But if it's more of a blue wave, meaning Democratic White House, Democratic Senate, and a Democratic House of Representatives, there might be and likely to be changes in economic policy. So the first and foremost that people talk quite a lot about is the higher corporate taxes, which are likely to increase from where they are today at 21% to 28%. which would bring it halfway back to the 35% rate that existed in 2017 prior to the tax cut under the current administration, and higher taxes on overseas earnings for some U.S. corporations. So that's likely to happen if there's, again, agreement across the White House, Senate, and House of Representatives. Also, expect higher household taxes for those earning more than $400,000 per year. That's in the documents in the policy statement for the Democratic Party. There's likely to be more regulation, whether it be of energy, financial services, and technology. There's been very light regulation over the last 4 years. So a bump up from there is likely. And then maybe some of the positive offsetting policies is that there's potential for easing of trade tariffs with China, which the market would appreciate. And there's likelihood of more fiscal spending, whether it's pandemic related, infrastructure spending, spending on healthcare, education, climate, and housing. These are all initiatives set forth by the Democratic Party. And if they were to win the White House and take control of the Senate and House of Representatives, we would expect some of these policies to be enacted. So I think that's important. I think the summary here is that while there might be some negatives to the market, there's also some positives to the market. It's really important not to overweight or overreact to one policy change over the other. So with that, our current outlook, I think it can be summed up really by looking at where we are today, which is that pandemic trade, this idea of a very heightened volatility and flight to quality that existed throughout most of 2020. And then looking beyond the short-term risks may provide some opportunity, and that's really what we're calling the recovery trade. And so we've been talking about that a lot, but economic conditions continue to improve despite the virus case count increases that we're seeing. Unemployment remains high. Uncertainty around what additional stimulus might be coming from Congress, and as we focused on just now, the upcoming election. But the equity market strength remains so far in 2020 in growth stocks, and valuations are getting stretched. However, recent trends, the last couple of days in the market, suggest that market leadership could be changing. And we continue ultimately to expect a U-shaped recovery that should result in a broader market with some of those economically sensitive sectors like financials, energy, industrials participating more going forward. And as we said before, that would be positive for Wescott strategy. So with that, we wanted to thank you again for joining us. Thank you for your trust. Please don't hesitate to reach out to me or your advisor with any questions. Thank you.